Thousands of retirement accounts belonging to older Americans are being locked down right now because of a silent banking regulation worth $10,000, and federal law actually prevents your financial institution from notifying you when it happens. Whenever you've placed $10,000 or more in physical currency into any banking location anywhere in America, a financial transaction form containing your identity, your account details, and the precise sum has been permanently recorded in a government system located in Vienna, Virginia, at this very moment. However, that represents just the initial regulation out of 5 separate policies, silently locking retirement funds throughout our nation. The most threatening regulation doesn't even need $10,000 whatsoever. It needs only slightly above $5,000, plus something your financial institution exclusively determines as questionable. Watch through to this video's conclusion, because the regulation that trapped 74-year-old Harold from Ohio represents the danger nobody anticipates. The protective measure to prevent it demands fewer than 20 minutes. The regulation sitting at this situation's core is named the Bank Secrecy Act. Our legislature enacted it during 1970, and that $10,000 limit hasn't adjusted in 56 years. Consider that reality for one moment. One loaf of bread during 1970 was priced at 25 cents. Currently, it exceeds $4. A brand new Ford pickup during 1970 was priced at $2,700. Currently, it exceeds $50,000. Yet the currency sum triggering a government report about your banking account has never received inflation adjustment. Not even once. During 1970, $10,000 represented a house down payment. Currently, it barely covers a pre-owned automobile. Every passing year, this limit remained unchanged, means additional ordinary retirees conducting ordinary activities become pulled into a monitoring framework initially created for narcotics operations and illegal money operations during the Nixon presidency. Here represents the initial regulation. Whenever you place or remove $10,000 or greater in actual currency during any individual day throughout all your accounts at that financial institution, federal law mandates the financial institution must submit a currency transaction report to the Financial Crimes Enforcement Network. They submit it using Finance Form 112. This report contains your complete legal identity, your Social Security identifier, your birth date, your account identifier, the precise sum, plus the fund origin if you shared one. The financial institution doesn't need to inform you they submitted it, and typically, they don't. This report enters a system every government law enforcement organization can access. The Internal Revenue Service can compare it with your tax filing. The Drug Enforcement Administration can search it during any probe. The Federal Bureau of Investigation can utilize it for building a background on you prior to any criminal suspicion whatsoever. What most older Americans don't realize is this regulation covers removals, not exclusively placements. When you enter your banking location and remove $12,000 in currency for purchasing a pre-owned recreational vehicle from an individual seller, that activates a currency transaction report on you, not the seller. When your spouse dies and you must empty a safe deposit container and the currency within totals $15,000, a currency transaction report gets submitted. When you redeem one single paper treasury bond at completion for $11,000, a currency transaction report gets submitted. This regulation doesn't consider why you're transferring the funds. It exclusively considers the dollar sum. However, this represents where the danger worsens. You must comprehend the second regulation prior to entering a banking location ever again. The second regulation is named structuring, and it represents a government felony you can perform accidentally. Structuring is outlined in Title 31 of the United States Code, Section 5324. The law states it constitutes criminal activity to deliberately structure transactions for evading the currency transaction report. The consequence reaches up to 5 years in government prison, a $250,000 penalty, and civil confiscation of funds involved. Here represents the aspect that astonishes every retiree learning this initially. You don't need to be concealing illegal funds to face structuring charges. You exclusively need to have divided a placement into multiple smaller transactions for maintaining any individual one below $10,000. A restaurant proprietor in Iowa named Carol Hinders operated her Mexican restaurant for almost 40 years. She placed her daily currency receipts always below $10,000 because that represented what her daily receipts were. The Internal Revenue Service confiscated her complete banking account, $33,000, without filing criminal charges against her whatsoever. She had to employ an attorney and battle for 18 months to recover her personal funds. A convenience establishment proprietor in North Carolina named Lyndon had $107,000 seized from his commercial account for identical reasons. The confiscation occurred prior to any probe, prior to any proceeding, prior to any magistrate hearing his identity. The government can seize your funds initially and dispute it subsequently. They've accomplished it to hundreds of ordinary commercial proprietors and retirees who merely placed currency the method they consistently had. Carol and Lyndon aren't the exclusive ones. Randy Sauerers operated a dairy operation in Maryland named South Mountain Creamery for over 30 years. He placed his farm stand currency receipts in sums typically below $10,000 because that represented what the farm stand collected during a weekend. The Internal Revenue Service confiscated $63,000 from his operating account. He wasn't charged with any criminal activity. He had to negotiate for returning most of his funds following a 2-year legal battle and substantial press coverage through the Institute for Justice. The sequence in all three situations is identical. An ordinary small commercial proprietor placing currency, the method their commercial operations naturally generate, it awakens one morning to discover the government has seized their funds initially and is requesting them to demonstrate their innocence subsequently. What the monitoring software searches for isn't one single large placement. It's a sequence of transactions clustering immediately below the reporting limit. Banking professionals and government investigators name these structuring indicators. A sequence of placements of 9,500, 9,200, and 9,400 across 2 weeks will trigger more intensely than one single placement of $30,000 because the sequence suggests an intention to evade the reporting limit. This matters for retirees in one very particular method. When you sell an automobile, sell a watercraft, sell a land parcel for currency, and you naturally stagger the placements because you believe that represents the more prudent action, you're performing the precise action the system is designed to flag. The financial institution doesn't understand your intention. The system doesn't understand your intention. It reports the sequence and allows the Internal Revenue Service to determine what to do with it. For retirees, the structuring danger appears like this. You sell an old motorcycle in your storage space for $18,000 currency. You understand that placing $18,000 in one day will activate a report. Therefore, you place $9,000 on Monday and $9,000 on Friday because you believe that represents the safer choice. You're currently violating government law. It doesn't matter that the funds are yours. It doesn't matter that you paid every tax you owed. The act of dividing the placement to prevent the report is the criminal activity. Therefore, the safer action is the opposite of what most individuals would presume. When you're transferring more than $10,000 in currency, place the complete sum at once. Respond to the banker's inquiries about the origin and allow the report to be submitted. A currency transaction report on a legitimate origin creates a documentation trail that safeguards you. A structuring charge on identical funds can cost you the funds and 5 years of your existence. Currently, we arrive at the third regulation, and this represents the one that trapped Harold from Ohio. It's named the Suspicious Activity Report, and unlike the Currency Transaction Report, it has no established dollar limit. It has no activation sum you can anticipate. It activates when the financial institution exclusively determines your transaction is questionable. Financial institutions submit over 4 million suspicious activity reports annually to the Financial Crimes Enforcement Network. Every major financial institution in our nation has an internal monitoring division whose exclusive function is scanning your transactions for sequences the software flags as irregular. When you typically place $2,000 monthly from a pension payment and one day you place $6,000, the software may flag it. When you normally transfer funds to the identical two accounts and one day you transfer $5,000 to a new account, the software may flag it. When you begin removing larger than typical sums in the weeks preceding a grandchild's wedding ceremony, the software may flag it. When it does, the financial institution submits a suspicious activity report, and they're legally prevented from informing you they performed it. That prevention is named Suspicious Activity Report, confidentiality, and a banking professional can lose their employment and face individual penalties for revealing a submission to the customer it concerns. Harold was 74 years old. He had remained with the identical community financial institution for 31 years. During February, his wife of 52 years died. The life insurance distributed $85,000. Harold placed the payment, and because the financial institution had never witnessed a placement that size on his account, their monitoring software flagged it. A suspicious activity report was submitted. Harold didn't know. 2 weeks subsequently, Harold attempted to move $15,000 to his daughter for assisting with his granddaughter's university tuition. The movement was prevented. His account was locked. The financial institution manager couldn't explain why. When he contacted the monitoring hotline, the representative stated exclusively that there was a restriction on the account and they couldn't supply additional details. Harold's account remained locked for 93 days. During that period, 2 of his automatic bill transactions failed. His Medicare supplement protection lapsed for 19 days, and his daughter had to transfer funds from her personal savings to cover the tuition payment. When the restriction finally cleared, nobody apologized. Nobody explained. The financial institution merely informed Harold his account was reactivated. Harold isn't exclusive. Margaret was 69 years old when her husband of 44 years died of a sudden cardiac arrest during March of last year. Within 60 days, she received a life insurance distribution of $120,000, a transfer distribution from her husband's individual retirement account for $210,000, and the funds from selling their second residence in Florida for $385,000. Every one of those placements was legitimate. Every one of them was legally hers. However, because 3 placements of that magnitude hit a retiree account that had previously averaged $4,000 monthly in activity, the monitoring software generated not 1 but 3 separate suspicious activity reports on her account in under 8 weeks. Her payments stopped processing. Her payment card was rejected at the grocery establishment. She was informed nothing about why. It required her attorney 4 months and a formal regulatory objection to get the restrictions removed. Meanwhile, she paid overdue charges on her property taxes, missed a refill on a prescription cardiac medication, and had to borrow against her daughter's payment card to bury her husband. What a restriction actually does to your daily existence is frequently worse than the restriction itself. A monitoring restriction typically prevents outgoing transactions initially. Your automatic mortgage transaction fails. Your property tax removal fails. Your Medicare supplement premium automatic deduction is rejected. Because most policies have a 30-day grace duration, if the restriction lasts longer than that, the policy terminates completely. Your life insurance premium, your long-term care insurance premium, and your auto insurance premium may all cascade into non-payment. The financial institution won't intervene to prevent these cascading failures. Monitoring divisions operate on a separate track from customer assistance, and customer assistance cannot access monitoring records. You're essentially locked out of your personal financial identity while the financial institution's internal procedure operates. The exclusive individuals who can accelerate it are financial institution monitoring officers who, by policy, don't accept telephone calls from customers. Most older Americans believe they'll never face this because they have nothing to conceal. However, this is a misunderstanding of how the framework operates. The suspicious activity report doesn't require evidence of criminal activity. It requires exclusively that the financial institution's software or monitoring officer consider the transaction irregular. Life insurance distributions, inheritance payments, resident sale funds, Medicaid spend-down removals, annuity surrenders, reverse mortgage advances, and retirement account transfers are all activators that appear regularly in suspicious activity report submissions. None of these are criminal activities. All of them can lock your account for 90 days or longer while the monitoring examination operates. However, there exists a fourth regulation, and this one particularly targets retirement accounts, which is why almost every older American watching this is vulnerable. The fourth regulation concerns how financial institutions handle retirement account distributions, and it depends on the structure those distributions assume. A direct transfer from one retirement account to another, managed through a trustee-to-trustee movement, is generally not reportable because no funds touch your individual account. However, the instant a distribution payment is issued to you individually, even if you intend to redeposit it into an individual retirement account within the 60-day transfer window, the financial institution witnesses an incoming placement that doesn't match your typical sequence. When the sum exceeds a limit the financial institution software considers irregular, a suspicious activity report can be submitted on the incoming funds. When you then transfer those funds out rapidly to complete the transfer, a second report can be submitted on the outgoing direction. You can activate two reports on identical funds, and you never understand what occurred. Required minimum distributions from traditional retirement accounts are another activator. When you're 73 years old or older and your required minimum distribution this year is $42,000, and you accept it as one single annual transaction, the incoming placement may be flagged. When you then utilize that funds to settle a large medical expense or finance a residence repair, the outgoing transaction may be flagged separately. The financial institution isn't attempting to harm you. The monitoring software is operating a sequence match on irregularities, and your retirement account distribution appears like an irregularity because it isn't a recurring sequence the software has previously cataloged. The dollar limits the monitoring software utilizes internally aren't disclosed, but consistent sequences appear throughout the sector. Wire movements over $3,000 to a recipient not previously in your account history are examined. Currency transactions over $5,000 in one single day, even if below the $10,000 currency transaction report limit, are examined manually by a monitoring officer. Incoming placements from origins the financial institution hasn't witnessed before over a limit the financial institution establishes based on your account history are examined. Here represents the compounding impact. A transaction that crosses multiple of these limits simultaneously, for instance, a wire movement of $6,000 to a new recipient, is more probable to escalate from an internal examination to a suspicious activity report submission than a transaction that crosses exclusively one. For an older American who has maintained the identical checking account for 20 years and who suddenly needs to transfer funds for medical treatment, a residence repair, or a family crisis, the internal examination limits are particularly severe. The account history the software compares your new activity against is the identical account history it constructed during your employment years and your early retirement. Your existent circumstances have transformed. The software hasn't. One single major medical occurrence, one single large inheritance, one single transfer from a 401k to an individual retirement account can push you into sequence territory the system reads as danger, not merely as existence. Every time one of these transactions operates through your account, whether it's flagged or not, the information is documented and added to your individual financial institution background for future comparison. For widows and widowers, the vulnerability is significantly greater. Spousal inherited retirement accounts, annuity beneficiary distributions, life insurance funds, pension survivor distributions, and joint account reassignments all appear during the identical grief window. Financial institutions name this the fraud triangle because individuals in the grief window are statistically more susceptible to deceptions. The software is calibrated to flag irregularities during that window for the widow's personal safeguarding. However, the practical impact is that more older American accounts get locked in the 3 months following a spouse's death than at any other moment in existence. Therefore, the safeguarding action for retirement account holders is to organize the transaction prior to it occurring. When you understand a large distribution is approaching, enter the location prior to the funds arriving. Communicate with an individual banker and inform them what you're about to perform. They cannot prevent the monitoring software, but a recorded conversation in your record provides the monitoring officer a justification to approve the transaction rapidly when it activates. What requires 90 days without that conversation can require 3 days with it. The fifth regulation is the most recent one, and it concerns something named beneficial ownership reporting. Until earlier this year, the Corporate Transparency Act mandated every small commercial proprietor, every trust with a commercial account, and every limited liability company to report their beneficial proprietors directly to the Financial Crimes Enforcement Network. For older Americans with family limited liability companies, rental property holding companies, small operations organized as limited liability entities, or living trusts that possess a commercial account, that meant submitting a new government report with individual information on every proprietor and every family member with a stake. A government court eliminated the Corporate Transparency Act as applied to domestic submitters in early 2026. The government reporting mandate was suspended, but state legislators have started filling the void. New York enacted the Limited Liability Company Transparency Act, which mandates beneficial ownership reports directly to the state. Other states, including California, Massachusetts, Pennsylvania, and Illinois, have introduced or enacted similar legislation. The practical impact is that many older American commercial proprietors who believed they were exempt from government reporting are currently facing the identical mandate at the state level with different timelines, different consequences, and different access to the information by law enforcement and private parties. The New York Limited Liability Company Transparency Act became effective on January 1st of this year. Every limited liability company established in or conducting commercial operations in New York must submit a beneficial ownership disclosure or assert a particular exemption. The initial consequence for failure to submit is $250, but the consequence for deliberately submitting incorrect information or for failing to update a submission when the ownership transforms can reach $10,000. California's proposed companion legislation would apply similar mandates to every limited liability company registered with the California Secretary of State and would make the information publicly searchable, not exclusively accessible to law enforcement. Massachusetts and Pennsylvania have versions at various stages of the legislative procedure. Illinois enacted its personal version last year with a 6-month grace duration that expires this summer. For an older American who possesses a simple family limited liability company, perhaps holding a cabin on a lake or a rental duplex in another state, the practical impact is that the submissions multiply. One entity may need to submit in multiple states, each with its personal form, its personal timeline, and its personal consequence for a missed timeline. Most older Americans have never heard the phrase beneficial ownership in their existences. Most small entity proprietors who established a limited liability company 20 years ago to safeguard one single piece of property have no awareness that a new reporting system currently governs that entity. The worst outcomes come from combining ignorance of the regulation with the cascading consequence structure. A missed $250 submission can grow into a dissolved entity, a lost asset safeguarding shield, and the individual vulnerability that the limited liability company was initially created to prevent. For older Americans with any of the following, the state reporting regulations apply or may soon apply. A family limited liability company holding a vacation residence, a single-member limited liability company utilized for rental property, a living trust that holds a commercial interest, an operation organized as a limited liability entity, a consulting practice operated as a pass-through company. The state forms can request individual information, including your residence address, your birth date, and in some situations, a government identification identifier. Missing the submission timeline can activate administrative dissolution of the entity, which in turn can reveal individual assets that the entity was shielding. Therefore, the fifth safeguarding action is to identify every entity you possess or control that holds a financial institution account or a piece of real estate, and verify its state reporting status with a licensed attorney or a certified public accountant prior to the conclusion of this quarter. Currently, here represents the action strategy. 5 steps. Each one requires fewer than 30 minutes. Initially, contact your main financial institution location and request the individual banker to record your most frequent placement and removal sequences in your relationship record. When you understand you'll be selling an automobile, emptying a safe deposit container, or receiving a large life insurance distribution in the next 6 months, inform them currently. The record notation safeguards you when the monitoring software flags the future transaction. Secondly, cease dividing placements to remain below $10,000. When you must transfer more than that in currency, transfer it in one transaction and allow the currency transaction report to be submitted on a legitimate origin. A structuring charge can cost you the funds and your freedom. A currency transaction report costs you nothing. Third, when you anticipate a retirement account distribution, a transfer, a required minimum distribution, or an inheritance distribution, contact the financial institution prior to the funds arriving. Arrange a 5-minute appointment with the location manager. Place the anticipated sum, the origin, and the intended utilization in the notations of your account. It won't prevent a flag, but it will reduce the restriction period from 90 days down to 3. Fourth, when your account ever locks without explanation, don't dispute with the teller. Request a documented statement of the restriction and the contact information for the monitoring division. Submit an objection with the Consumer Financial Protection Bureau the identical day. An objection creates a documentation trail and requires the financial institution to respond on a government schedule. In most situations, the restriction removes within 10 commercial days following a Consumer Financial Protection Bureau objection is submitted, even if the underlying suspicious activity report examination is still active. Fifth, when you possess any entity that holds a financial institution account, a rental property, or a family commercial interest, compensate a licensed attorney or a certified public accountant in your state to examine your beneficial ownership reporting status prior to the conclusion of this quarter. The government mandate is suspended. The state mandates are accelerating. Miss that submission and the entity dissolves, and every asset it was safeguarding walks back into your individual liability.